but according to Fair for All Finance, according to a number of other studies in the UK, there are around 15 million people who struggle to get affordable credit in the UK. Of those 15 million, between 6 and 8 million people have little or no credit history, and they are excluded from mainstream financial services. They're people on low income families, perhaps people who rely significantly or wholly on benefits, or people who suffer life shocks, whether it's falling ill or losing their job, and all of this impacting on their credit score. And these are the people that we serve, the people with the lowest decile of income in the UK, people who are unable to get any a credit from mainstream financial services, and their only options really are to go to illegal lending, to go to very high cost predatory lending, or to go without. Credit unions do a fantastic job. We have great relationships with a number of them. There are 250 or so more across the UK. They're community-based often, and they have a very different business model to what a CDFI does. At Fair for You, we provide instant lending decisions for people who have no connection with us. They're not savers, as often credit union members have to be before they can borrow. And also we specialize in smaller loans, micro loans, loans averaging of about £350, whereas often credit unions can't make that work, and they have to, and they lend greater sums beyond £1,000. Fair for You was set up, therefore, with this backdrop, knowing how difficult it was for people like Jennifer to get a loan for essential household items. We were set up in 2015 to try and combat the poverty premium, where in a family where a major appliance, washing machine, fridge, goes wrong, and there's no savings in the family to buy a replacement. And the alternatives for that family are either to go to a legal lender, to go to a high-cost lender, to perhaps buy false economy, a second-hand refurbished appliance, or to do without. And that's the poverty premium, because each of those options costs a lot more than somebody who has a decent credit score and who could borrow some money in order at a lower interest rate to purchase a new item. So we developed a business model whereby we can lend to people like Jennifer sustainably, effectively, affordably, and responsibly. Don't forget, our demographics don't quite match up. So people who we serve, as I said earlier, are really in the lowest income bracket in the UK, and that means that quite often, actually, not just credit unions may not be lending to them, but also they're unable to get, for example, buy now, pay later type of services either. So we've got to put that into perspective. Also, credit unions tend to want you to be a member of the credit union before you can borrow. Our business model is that people apply online to our website for a loan instantly. They get an instant response and can go and purchase the item that they need there and then.
And one is around flexibility here. So I think for our customers, the flexibility of being able to make changes to their payment plans is really important. So their income fluctuates in terms of what they receive, the frequency when it comes in. And so having kind of fixed payment options for them is often quite a challenge. So sometimes it can be, I can't pay you today, but I could pay you in 2 days. And we allow our customers to change their payment plans with us in terms of frequency whenever they want. So they can change from weekly to fortnightly, monthly to 4 weekly, whenever they want. There's absolutely no fee for doing that. They can do it pretty much 24/7 via their online dashboard to be able to do that, so that it flexes for them, so that they allows them to minimize the chances of missing a payment. And that's really important for them because that income is so inconsistent sometimes in terms of the timing. And often some of the other providers don't allow you to do that. They'll often charge you for the ability to do that, or there's a long time lag, or you have to re-sign your loan agreement and things like that. We allow them to do that frequently, which I think is really something that our customers benefit from, particularly if there's a one-off, event that's happened. It's somebody's birthday, it's Christmas, there's challenges that come with that. The other piece is just going back to the average loan size here. So for a lot of credit unions, they're really struggling to do smaller loans, like Simon has mentioned. We work with credit unions, we talk to them, we're at a lot of the similar events. And sometimes to be able to do a 100, £200 loan is really difficult for a credit union. From a financial perspective, it's challenging for them to do that. So either they have to decline the customer and say, I can't provide you with that small loan, or they're having to encourage the customer, I can't give you that, but I could give you more. There's an ethical question there around, should we be encouraging people to take out more lending than perhaps they're originally intending to? So I think there is a really valid place in the sector for small micro lending for those that are able to do it. And we've been able to build our business model with the tech that enables us to do that small lending really, really well with the flexibility that customers need. So I think absolutely there's a place for credit unions and other providers in the market, but I think what we are offering is slightly different, and it depends on the customer. And what we would always encourage the customer to do is to look at what's the best option for them at that time. If required, we would give wealth warnings and things like that to support customers to make the best decision. But at the end of the day, we have to enable customers to make that decision themselves.
So let's just look at the APR issue. We charge 64.8% APR. That is 4.25% per month on outstanding balance. And you may then be wondering, how come we are cheaper than other organizations with lower APRs? The reason is because we bake in the assumption that our customers will miss payments. We do not have penalty charges, either for late or for overpayments, and we have no annual fee. So for micro lenders like us, an APR is a very unhelpful way of measuring how much our customers pay. If we take a £100 loan, APR is calculated on the fact that you take out the loan on day 1, and on day 365 or week 52, however you're calculating it, you've paid nothing. And you therefore end up with a sum of £64.80 in our case. But that, of course, doesn't happen. For our customers, they take out the loan on day 1 and they start paying it off. And if someone keeps to plan on a £100 loan over 12 months with Fair for You, they actually end up paying just under £29 interest, an APR or an interest rate of 28.5% or 29%. And of course, if our customers overpay, as many of them do, then that interest rate for the year is even lower. So what we find is that APR is inapt, and actually, when you look at some of our other competitors, if you like to use that word, we are much cheaper than, for example, Klarna. I know Klarna's mentioned 22% APR, but of course, each missed payment is £5, and it doesn't take many missed payments to suddenly have an equivalent interest rate of north of £22, so of 22%. So it is a difficult thing to get across to people who are used to perhaps having a much lower APR. The way I would suggest you might look at it before I hand over to Emma is that, you are looking at this from an APR that you could probably get on a loan of about 6, 7, 8% down here, and we're here at 60, 64, 65%. Customers like Jennifer, their option is 1,000% APR. They're up here, and to get an option of an APR down at where we are at 64, 65% is very unusual indeed, and that's why so many of our customers, tens of thousands of our customers, come back to us time and time again. That's why we have Trustpilot scores of 4.8, 4.9%, 4.9 out of 5, and why we are being feted by so many social impact reports as being an organization that others should follow in terms of business model to provide services and loans to affordable loans to people like Jennifer.
And the other piece that I was going to talk about is about that social rate of return for every pound that's being invested. So if you've been able to have a look at some of the paperwork around the social impact work that's been done, for every pound that's been invested into Fair for You, the social return of that is £16.60. So there's a huge social return in terms of what's being delivered via Fair for You for its customers. The other point that I'd make is more about a qualitative social return as well. So if you look, as Simon's mentioned, at our Trustpilot reviews and at customer testimonials, that's where we really hear from the people who are struggling, the people who are, at the coalface of what's going on with the cost of living crisis, of the impact that Fair for You has made for them. And I would really encourage you to go and have a look at that. I looked at it this morning in the last kind of reviews in the last few days. There's things like Lifesaver, Lifeline. And that's what Fair for You is for a lot of people. It's not for everybody. I think that's the point that I'd really want to make, is that we are not stating that everybody should be going out and taking credit and everybody should be taking credit from Fair for You. But for our customers who this works for, it works for them incredibly well. So there's a huge population that need help to access credit for essential items and services. And I think we'll all agree that that situation has only been exacerbated by the recent cost of living crisis, where everybody's budgets are squeezed. And if your budget was already minimum, has been squeezed already, there really isn't much more left for people to go to. So the first point is around growing that loan book, being there, being able to have the capital to support the customers who want to come to Fair for You and want to use our services. The second point is around technology. So, we're planning future enhancements to enable our customers to do more self-serving, so they've got that confidence 24/7 that they can deal with what's ever happening on their account. We want to focus as well on consumer understanding. I think that's something that, we're all really aware of, is that finance and finance education and the, legal agreements that come with these things can be quite complicated. There's certain amounts that we are obliged to include. We really want to improve how customers are able to understand and make sure they know what they're signing, video tutorials, different bits and pieces that go in that dashboard to enable people to feel confident and empowered to make their own financial decisions.
Illegal lending is a blight on our financial system. As payday lenders, who we have no love for, were regulated and are being regulated out of the market, and doorstep lenders equally regulated out of the market, there is a gap, and that gap needs to be filled by organizations like CDFIs, like Fair for You, like credit unions, and many others, because otherwise, in that gap, illegal lending loan sharks fill it. And the most recent report by Fair for All showed that over 2 million people in this country are using an illegal lender, and that cannot be right. We work very closely with all the financial institutions in our sector and the government to try and lobby hard for government to do more in enabling an ecosystem whereby we can all work together more to help the customers that we serve.